Welcome to Talk Tickers. Today, we are plunging right into the operational engine room of global finance. We're looking at what might be the fastest, but also the quietest revolution happening in market structure right now, the settlement cycle. Our mission for this deep dive is to analyze the U.S. market's really successful shift to T+1, that's settlement one day after a trade, and then map out the much tougher journey toward true instantaneous settlement, or T+0. So for months, it felt like the entire U.S. securities market was holding its breath for this huge operational shift. And then on May 28th, 2024, it happened. The T+1 transition went live. The initial data gives us this really fascinating snapshot of success. What stood out to you in the immediate aftermath?
Well, what's really interesting is that the results weren't just, acceptable. They weren't just okay. They immediately delivered on that core promise, which was all about risk reduction. The industry basically reset its clock, and the whole system just responded with more stability right out of the gate.
Okay, so let's unpack that. Let's get into some measurable evidence of that success. We know the back office was under enormous pressure to just speed everything up. Did that pre-settlement discipline actually hold up?
It absolutely did. And the most crucial metric for that, for internal preparedness, is what we call affirmation rates. That's just making sure the buyer and seller agree on all the trade details and quickly. We saw those affirmation rates by the critical 9 p.m. Eastern cutoff just soared to nearly 95% immediately.
95%. And what was it before?
To put that in perspective, earlier in the year, that rate was often hovering closer to, say, 73%.
Wow.
So yeah, that's a monumental cultural and procedural leap forward.
A nearly 25% increase in people doing what they're supposed to do on time. That shows real commitment. But the real goal wasn't just speed for speed's sake, right? It was about mitigating systemic risk. How did T+1 affect that financial cushion that's required to absorb potential losses?
This is probably the most compelling piece of data. The whole point of T+1 was to shrink the window for market exposure. And we saw the average value of the NSEC clearing fund, that's the capital pool required to guarantee trades if a member defaults, it decreased by $3 billion.
$3 billion. So less capital required to keep the system safe. What does that reduction actually mean in practical terms for market stability?
It means the entire system is safer, period. The time you have to cover losses from a failure has been cut in half. Less time means less exposure to crazy price swings. A 23% reduction in that required clearing fund is basically proof that the infrastructure needs less collateral to handle the same volume of trades. And that capital is now freed up for more productive uses across the whole financial ecosystem.
That reduction is a massive endorsement of the move. But, a lot of people were worried that by compressing the timeline, you'd just see more trades fail. Did the tighter deadline cause some kind of settlement breakdown?
Surprisingly, no, not at all. Settlement discipline held remarkably steady. If you look at the core metrics from, say, July 2024, the average fail rate for trades handled by the Consolidated Netting System, or CNS, was about 2.12%. And the DTC non-CNS fail rates were around 3.31%.
Okay, can you just quickly, what's the difference between CNS and non-CNS fails for someone listening?
Yeah, good question. CNS is the mechanism run by the NSEC that basically nets all the buys and sells for a firm into one single settlement obligation for each stock. It handles the vast majority of trades. Non-CNS trades are usually high-value, more bespoke transactions. Think certain corporate actions, private placements, things that settle directly outside that main netting system.
Got it. So the fact that both of those fail rates stayed consistent with the old T+2 averages.
Exactly. It proves the system is resilient, even with a compressed clock.
That's a really strong foundation. And it's important context for you, the listener, to know that the success wasn't, an overnight thing. It's really just the latest step in a decades-long push for more speed.
We've been accelerating this process for over 30 years. It's not some sudden impulse.
That's right. If you look back before 1993, the market operated on T+5, a full week for a transaction to officially settle, which was largely a function of, physically moving paper stock certificates and checks around. Then it dropped to T+3 in 1993 once electronic systems took over, then T+2 in 2017. This shift to T+1 is just the most aggressive step so far.
And every single one of those reductions has been driven by the same thing, reducing systemic risk. Shorter cycles just limit the chance that a firm goes bust before it delivers the cash or the securities it promised.
And the most recent catalyst for this T+1 mandate was, of course, the insane volatility around GameStop and stocks like it back in early 2021.
Precisely. The GameStop situation just highlighted that when prices swing wildly and volumes explode, that 2-day settlement window creates this enormous capital requirement and risk for clearinghouses and brokers. The regulator saw that and basically used that event as the leverage point to force the industry to finally clean up its act and shorten the cycle.
So T+1 is now the standard in North America. What about the rest of the world? Are we creating a fragmented market here?
It is absolutely a global movement, but it's on a delayed timeline. The UK and the European Union are already lined up for a mandated T+1 implementation on October 11th, 2027. And that synchronized approach is critical because fragmentation, having one major market settle faster than another, causes some serious pain in cross-border transactions.
And if we look further east, towards the big financial centers in Asia,
Asia-Pacific markets are expected to follow, but probably a bit later, closer to 2030. You'll likely see the more developed centers like Singapore and Australia lead that charge. So while it's not happening all at once, T+1 will become the global standard over the next, say, half-decade.
Stepping back for a second, what are the tangible, immediate benefits T+1 provides to the end user, the institutional fund manager, or even the individual investor?
For the investor, it just means faster access to your cash and your securities. If you sell a stock on Monday, that cleared cash is available by the time the market opens Tuesday. It increases your capital efficiency. It gets rid of a full day of your money just sitting in limbo.
And for the big institutions?
For them, the benefit is really reduced cost, specifically around risk management. The less time they have open exposure, the lower their capital holding requirements are for margin calls and compliance. So less exposure equals lower operating costs. It also means fewer of those high-touch, error-prone manual tasks you need to manage a delayed settlement.
All of which, naturally leads us to the next inevitable question. If T+1 was so successful, is T+0 instantaneous, same-day settlement just a small step further? The consensus seems to be that T+0 is inevitable, but at the same time, almost impossible right now.
T+0, or true instantaneous settlement?
Yeah,
it's seen by almost everyone in the industry as the ultimate destination. It's driven by the fact that instant solutions already exist in things like retail banking and, of course, the crypto world. We want that safety of having positions fully settled immediately.
But the industry view is pretty clear. T+0 is not just T+1 with a bit of extra speed. It requires a complete revolution. Why isn't it just another incremental step like all the previous ones?
Because T+1 was basically achieved by forcing existing and often manual processes to just run faster. We saw anecdotal evidence that a lot of firms actually hired more staff just to work through that compressed T+1 window. They were essentially throwing bodies at the problem instead of technology. T+0 completely eliminates the possibility of human intervention.
You just hit the nail on the head. You can't ask a manual system to complete a process in 0 time.
Exactly. T+0 requires fully automated real-time processing where any kind of high-touch task like confirming trade details or fixing a minor error is totally eliminated. If a human has to touch it, the T+0 window has already been missed. So the industry knows that T+0 is going to require a huge independent review before anyone even tries to implement it.
And this compression to T+1 has already created some massive operational friction, especially across global borders where the time zones are just unforgiving. Let's talk about some of the operational nightmares T+1 is creating right now, starting with this ETF funding gap.
This is a classic example of that fragmentation friction. Some people call it the Thursday effect. It mostly affects those cross-listed ETFs, especially ones that are domiciled in the EU but hold underlying U.S. assets.
Explain that misalignment for us.
Okay, so when an authorized participant, or an AP, sells a share of an EU domiciled ETF, that share now settles on T+1. But the AP receives the underlying U.S. stocks, the assets that make up the fund, which might still be settling on a T+2 or even T+3 basis globally. This creates a critical 24-hour funding gap for the fund.
So the fund gets the cash from selling the ETF faster than it gets the stocks it needs to generate that cash. That creates a temporary cash surplus.
Correct. And that surplus immediately puts the fund manager at risk of breaching some very strict EU regulations called UCITS. Specifically, the fund might violate the 20% deposit cap if it's holding too much cash, or it could breach the 10% borrowing ceiling if it's forced to borrow to cover the mismatched delivery.
And for listeners outside the EU, these UCITS rules are really important. They're there to make sure the fund is liquid and diversified, so breaching them is a serious regulatory risk, not just some accounting headache.
It forces these costly, complex workarounds. Issuers have to use prearranged credit lines or these complex cash sweeping setups across different banks just to stay compliant. T+1, in this cross-border context, has actually added cost and friction for some of these funds.
That's a serious drag. The other major friction point is the foreign exchange bottleneck. This is compounded by the tyranny of time zones, especially for European firms that need to get their hands on US dollars.
The timing is, it's almost impossible for same-day execution. A lot of European trades need USD funding. And the critical cutoff time for CLS, that's continuous linked settlement, is 6:000 p.m. Eastern Time.
Okay, and what exactly is CLS, and why is that cutoff so important?
CLS is the mechanism that settles both sides of an FX trade at the same time. It's called payment versus payment, or PVP settlement. It's really the only way to eliminate principal risk, the risk that you pay your counterparty but you don't get the currency you bought. And that 6 p.m. EST cutoff is a hard stop.
And meanwhile, what time is it in London or Frankfurt when that 6 p.m. deadline hits?
European trading can run as late as 10:00 p.m. Eastern. So this means European participants trying to get USD funding have essentially zero window between their market close and the CLS cutoff to execute their FX trade and get it settled for T+1.
Zero window. That sounds like a logistical nightmare.
It is. And think about the sheer volume we're talking about here.
Yeah.
This timing constraint affects an estimated $50 to $70 billion in European FX trades every single day. So without being able to use CLS, those trades either get pushed to the next day, which increases risk, or firms have to pre-fund, which ties up billions of dollars in capital. It's a massive pressure point.
So given that T+1 has exposed all this deep reliance on manual work and all this cross-border friction, what are the genuine prerequisites for actually achieving T+0? It sounds less like a financial problem and more like a cultural and technological one.
It is fundamentally a cultural revolution. You absolutely need advanced technology, and I'm not just talking about faster mainframes. The process has to be intelligent enough to fix itself. This means relying heavily on artificial intelligence and machine learning to automatically reconcile and fix minor exceptions without a person ever looking at it.
So we need technology that's a proactive problem solver, not just a data processor.
Precisely. And the general view is that the T+0 solution will probably be led by more nimble tech firms that can build these systems from the ground up. Not necessarily the traditional large infrastructure providers who might be, hesitant to disrupt their own models.
And that leads right back to the biggest hurdle, getting rid of those comfortable old manual standards that everyone has used for decades.
It's the core DNA change. The industry has to completely retire things like batch reporting, emailing spreadsheets, and yes, spreadsheets are still used extensively, and rely on things like FTP and SFTP file sharing.
It is amazing to think multi-billion-dollar trades are still reliant on someone emailing a spreadsheet.
It happens. The back office needs to start being a factory floor built on manual labor. It needs to become a high-tech control center staffed by a much smaller number of highly skilled experts who only handle the really complex, unique exceptions. So for you, the listener, the one question you should always be asking about this acceleration is this: how quickly can the industry eliminate its dependency on manual back-office intervention, like spreadsheets and batch processes, across global borders?
Because the journey from T+1 to T+0 is less about technology speed and far more about achieving a global cultural and procedural revolution. And that's the only way to realize the full risk and cost benefits that instantaneous settlement promises. And that brings us to the end of today's deep dive. We've navigated the metrics showing the really successful risk-reducing transition to T+1 in the US. But, crucially, we've also uncovered the profound, transformative challenges of reaching that next milestone, T+0. It's all driven by these deeply embedded manual processes and the major cross-border frictions we've seen. Future success really hinges on abandoning all that and investing in truly intelligent, automated infrastructure.
Yeah, it's abundantly clear that the work required for T+0 is transformational. It's so much more extensive than the T+1 transition was. We'd encourage you to keep analyzing how firms are addressing both the cultural and the tech hurdles to get to that instantaneous global settlement, and especially watch which tech firms start to lead this charge.
Thank you for joining us for this deep dive.